Good afternoon, ladies and gentlemen. My name is Johan Heidenrug. Welcome to today's webinar on the series of COVID-19 measures that the government has taken. For the first three webinars, we discussed the actual application processes. We discussed the relief that is provided through special legislation. And in the next three webinars, we are going to explore more the practical implications of certain events that may either be unique to this period or that may change over time as we change the way that we work, change the way that we have a lifestyle. Then we will explore what the impact of that will be. In today's webinar, we're going to discuss the relationship between the employer and the employee, which is anticipated to change not only over this period of the lockdown, but over the short to medium term as well. And we look at certain practical things that are happening. In webinar 5, we'll be discussing the impact on the company that is providing consumer goods, the impact of Consumer Protection Act, and many events that have an impact on them. And then in webinar 6, we'll be discussing the impact on the large company that may be a mine or maybe a factory, and the implications of this period on them. So for today, we're going to discuss a number of topics, and as you can see, they are very practical and very event-driven. So we'll just discuss what the relief is on the disaster relief trusts. Then we'll talk about a very important topic. What will now happen if you're unable to pay the PAYE income tax or VAT, in particular this PAYE that's now being deferred? We'll talk about what is the tax treatment of expenditures incurred by employees whilst they're working from home. What are the consequences if you're an employer and you decide to assist your employee through various means? And then from the perspective of the person that is trapped in a foreign country and he can't return, he may have been there for business purposes, and now he can't return and there are certain costs that's got to be paid. We will discuss the rules governing travel facilities provided by an employer, the impact on how you will keep your logbook if you're an employee and have a travel allowance or you enjoy the use of a company car. Also discuss what that treatment would be. If there is a Section 1010 for an employment exemption, see what that impact will be on you as an employee. We'll talk about whether there are special rules for medical costs that an employer may pay, and then also how can I incentivize my employees to actually become involved in some of these PBOs that are designed for disaster relief. In the draft Disaster Management Tax Relief Bill, a COVID-19 Disaster Relief Trust is defined as any trust established by the sole purpose of disaster relief in terms of the COVID-19 pandemic. And these trusts are effectively the private sector's contribution to addressing the pandemic. This extracts from the explanatory memorandum on this draft Disaster Management Tax Relief Bill. It talks about the type and manner of funding envisaged by these private donors. So the trust will be formed, and effectively they will be providing loans. The first loans will be funding structures to form loans to the SMMEs, but the second category is actually important because it talks about that the trust will effectively provide a loan to the SMME, but won't pay the money to the SMME, will in turn pay it to an employee. The money will be directly paid in the form of a weekly allowance to the employees, but it will then be a loan for the employer. And that loan will then be a soft loan, and the employer will then be able to pay it back over time without any interest, and it will maybe subordinated in favor of other loans. So what would the consequences of that be? So before we carry on, there are 4 extracts from the explanatory memorandum. So firstly, it's about the tax treatment of the relief fund itself. For the period up to 31 July, it will be regarded as a public benefit organization. So they won't need to go through the formal application processes for PBO, but they will have to be applied, approved by the commissioner, but it won't go through the normal PBO process, but they'll have an approval, automatic approval from the 1st of April to 31 July to be a PBO. After the 31st of July, they will be deemed to be a small business funding entity, which was also exempt in terms of Section 30C. So it's a bit of a funny arrangement because from the 1st of April to 31st of July 2020, they'll be regarded to be a public benefit organization, exempt in terms of 10(1)(c)(n), and thereafter they'll be deemed to be a small business funding entity as contemplated in 30C, also exempt. Now, what will happen with any donations that people will be making, companies or individuals will be making? So for the period, only for the period between the 1st of April and 31st of July, that will qualify for a deduction in terms of Section 18 Cap A. And for companies, they can get a tax deduction up to 10% of taxable income, and for individuals up to 5%. And that will then be a deduction that you can enjoy if you make a contribution. So people will be encouraged to do that. As we're talking today about the relationship between employer and employee, if you are SMME and you are enjoying a benefit under the category where this trust will be paying salaries effectively on your behalf, and that will be constituting a loan, there is an exemption from PAYE, and there's no need then for you as an employer to deduct employees' tax from this salary that is paid on your behalf. Because remember, all that will happen is the money will flow directly to the employee, but it's still paid on your behalf, and there will still be a liability of PAYE. But in terms of the disaster management tax relief bill, there will be no obligation to deduct that PAYE. But remember now, this is not exempt in the hands of the recipient. So the employee will receive this money, there will be no PAYE deducted. But when that employee now submits his tax return at the end of the year, he'll have to pay in. So there will be an obligation. And if you do enjoy that, it is very important that the employee must understand that there would be a tax liability once the tax return is submitted. So this leads us to a bit of a discussion in saying, what will now happen if I can't pay this tax? So let's just first look at some of the other sections in the Act that is not being changed. So the first thing is Section 234 of the Tax Administration Act says that a person who willfully and without just cause fails or neglects to withhold and pay to SARS an amount of tax, as and when required under the Tax Act, is guilty of an offence, and upon conviction is subject to a fine or to imprisonment for a period not exceeding 2 years. So under the COVID-19 situation, we do expect people to now suffer and not be able to pay this tax. So this can apply for the 20% PAYE that you do not withhold, but you are obligated to pay it back over 6 months. If you do not pay it back, then you'll be held guilty of an offence if it is willful and without just cause. So hopefully one will regard financial difficulties to be without just cause, but it would be nice if SARS just issues a media statement or something to say that that will be regarded as such. One should also look at paragraph 30 of the 4th Schedule to the Income Tax Act, and it says, and it talks about, obviously the 4th Schedule deals with the employee's tax, but also provisional tax. It says that any person who willfully and without just cause becomes liable for any remuneration, either don't deduct the PAYE or fails to pay the PAYE to the Commissioner when required, or, and this is quite an important one, uses or applies any amount deducted for purposes other than the payment of such amount to the Commissioner. Because remember, the PAYE is actually you deducting it, withholding. It's not your tax. You're withholding the money on behalf of your employee. If your employee is earning 20,000 Rand per month and you're withholding 5,000 Rand for that month, you're only paying an amount of 15,000 Rand to the employee. But that is not your money. You are due 20,000 Rand to that employee. So in terms of the normal rules, if you deducted 5,000 Rand, you cannot use that 5,000 Rand for any other purpose than the payment of such an amount to the Commissioner. If you do that, you'll be guilty of an offence and liable on conviction to imprisonment. Now, if you're suffering serious financial hardship because of the COVID-19, one can argue that it is not willful and it is with just cause. But be careful, and one should not just assume that SARS will not impose this. Let's talk about the tax liability and the payment. It is interesting that the 4th Schedule already allows the Commissioner to grant approval that there should be no PAYE deduction. What the paragraph 11th of the 4th Schedule says, that the Commissioner may, having regard to the circumstances of the case, issue a directive to an employer authorizing that employer to refrain from deducting any employment tax in order to alleviate hardship to that employee due to circumstances outside the control of the employee. So the reality is, SARS could already have used, they didn't need a law change. They could have used paragraph 11 of the 4th schedule and just authorizing certain employers not to deduct any employee's tax. But remember, this 20% is actually you are deducting the employee's tax. That is there to be a soft loan to the employer, and therefore the employer will, for the period from April to July, not deduct. They'll still deduct the employee's tax. They won't pay the gross amount to the employee. They'll still deduct it. But then 20% of that POA that has been deducted, they will not pay over to SARS. So effectively, it becomes a soft loan to the employer. And then after that, they are obligated to pay it over. In this case, SARS can actually allow you not to deduct employee's tax at all. So this SARS could have used, for example, on the money that will come from the disaster relief trusts that will be paid directly to the employees of SMMEs. But fortunately, they did change the law there, but they could have used this section as well. There may be situations where any employer can actually go to SARS and say, I have employees that's now really suffering hardships. They have gone on reduced pay. They don't have enough money, so I've paying them maybe 50% of what I normally would do, and now they're suffering financial hardship. Can I please have approval not to deduct any employees' tax from their salaries? This can also apply if a taxpayer is suffering financial hardship. They can approach SARS and ask for a deferral arrangement. Now, deferral arrangement is essentially an installment payment arrangement. So how does that work? It needs to be negotiated with a senior SARS official, and there needs to be qualifying criteria for that deferral arrangement. All of this comes from Section 167 and 168 in the Tax Administration Act. The qualifying criteria is that the taxpayer must suffer from a deficiency of assets or liquidity. So it's got a lack of assets, lack of liquidity, and this is not necessarily able to remediate it in the immediate future. Or the taxpayer anticipates income which can be used. So the taxpayer is suffering from an immediate cash flow problem. The taxpayer is suffering from a deficiency of asset, but they do anticipate income to come from in future. So once the lockdown is lifted, then my restaurant can operate again. I'll have customers again, and I'll be able to do this. So, and I will be able to work myself out of that. An immediate collection activity would be harsh, or the taxpayer can even provide security. So if any of these things are present, then the taxpayer can approach SARS and say, I want to defer my payment of my income tax liability, or even VAT liability, and try to get a deferral arrangement for that. This can be modified by SARS if SARS believes that the collection of tax is in jeopardy. Because remember, there's no, under this deferral arrangement, you still need to pay the tax. It's just paid in installments. If SARS gets to a point, they say, but hang on, you're going to emigrate, or you are getting rid of all your assets, and the collection of tax is then in jeopardy, then SARS can say, no, I want to immediately collect my money. Or if the taxpayer has supplied materially incorrect information, he has provided not information of investments that they may have, or a separate bank accounts, or the financial condition has changed materially, has improved overnight, there has been a very immediate inflow of cash, then SARS can also change this installment payment agreement. But this can potentially be used in order to assist taxpayers who are suffering from cash flow problems in this time. SARS can obtain a preservation order. So when can a preservation order be obtained? It is when SARS is concerned that certain realizable assets may be disposed of, which will mean that SARS can't collect the full tax. So if a taxpayer has got a big tax liability and they are now disposing of all the assets, and SARS believes that they won't be able to get the money back, then SARS can obtain a preservation of order from court. SARS may seize the assets even if they're just anticipating a preservation order from court, but there must be certain requirements from that. And that will remain in force until it has been set aside on appeal, or until it is no longer required because the tax debt has been paid. So it depends on how hard SARS is acting, but SARS have got certain rights to lay their hands on certain assets of taxpayers who are in default. So the process of writing off a tax debt, Chapter 14 of the Tax Administration Act talks about a temporary write-off of a tax debt. That's under Section 195 and 186. This happens at a SARS level. This doesn't happen this is not a negotiated. And this happens when SARS looks at the tax debt and they say, we are satisfied that this tax debt is uneconomical to pursue, or that the tax debt is subject to business rescue proceedings. So it's quite important that if there's a temporary write-off of a tax debt in terms of Section 195 and 196 of the Tax Administration Act, this does not absolve the person from being liable for the tax debt. And the decision to temporarily write it off can be immediately withdrawn if SARS believes that this is not necessary anymore. This is typically the same thing that a company in the private sector will use as a provision for a doubtful debt. But there's certain things that SARS needs to consider. So when is it uneconomical to pursue? When the cost of recovery is more than the anticipated amount to be recovered. So, for example, the taxpayer owes me 10,000 Rand, but it's going to cost me 15,000 Rand to collect it, then it's uneconomical. The following factors has to be considered is how much is the tax debt. If it's a small amount, maybe we should just temporarily write it off. If it's been long outstanding, the chances of successfully recovering becomes less. Is the person living under a bridge? What have you done to date in order to trace this taxpayer? You can't even trace him. And then is the cost more than this? And then the financial position of the person owing the tax debt is just entrenched. He has got no assets, and we can temporarily write this off. So the temporary write-off is effectively a provision for a doubtful debt. SARS makes the decision. They don't go to the taxpayer and say, "I'm now temporarily write it off." They're just doing their own accounts and temporarily write it off. A compromise of the tax debt is something totally different. And this is defined in Section 192 of the Tax Administration Act. It is an agreement, so as you can see, it's an agreement, formal agreement, entered into between SARS and a taxpayer who has a tax debt. The taxpayer undertakes to pay an amount which is less than the full amount of the tax debt. And that payment is then made in full satisfaction of that tax debt. And then SARS undertakes to permanently write off the remaining portion. It is a formal agreement, and it's a formal compromise with a creditor that the taxpayer enters into. So Section 201 of the Tax Administration Act says that compromise must be signed by the taxpayer. And this is a request. So you can't just, you don't just run into the agreement. You must first be a request for a compromise. So the taxpayer actually approaches SARS and say, "Can I have a compromise?" So that application, that request, must be signed by the taxpayer and be supported by a detailed statement. That detailed statement must set out a whole host of things. It must state out the current fair market value of all the assets and the liabilities of the taxpayer, the amounts received by or accrued to all of his expenditures in the last 12 months, his assets that have been disposed of so that SARS can see if not dissipated your assets in the previous 3 years, future interest in assets, perhaps there is a inheritance that's coming through, any details of connected persons, your spouse or maybe connected companies, and then what anticipated income you'll receive in the next 3 years, and the reasons they're asking for a compromise. And all of that must be supported by a whole host of evidence. So the considerations, SARS will then consider whether or not they should do the compromise. SARS can say, okay, it is worthwhile if there's a saving in cost of collection. SARS can say it's worthwhile doing this if the collections are earlier than what it otherwise would have been, and whether or not the collection cost would be more, and whether or not the amount of collection would be better. If I can do a compromise now, get 50 cents in the rand, if I leave it and they get liquidated, I'm only get 20 cents in the rand. The final bullet is, it generally also goes with an abandonment by the taxpayer of some other claim or right. So, for example, there may be a tax due for 2018, and there's assessed loss in 2019. And SARS may say, okay, I will compromise your 2018 debt, but you will lose your assessed loss in 2019. Or you may have a Section 6 quad credit due to you, and it may be that you will then forfeit any 6 quad credits that may be due to you. So a compromise generally is also associated with abandonment of any losses, any capital losses or the like. So when is a compromise not appropriate? Is when there has been a compromise 3 years before that, and again, the tax affairs of the taxpayer are not up to date. As you can see also through all the COVID-19 special dispensations on the ETI and all those things, it's always important that the tax affairs of the taxpayer are up to date. It's not appropriate if another creditor said they're going to initiate liquidation, or if the compromise will prejudice other creditors, or if SARS is prejudiced in favor of other creditors, or it adversely affects broader taxpayer compliance. If a taxpayer, for example, is involved in fraudulent schemes and they then compromise, it doesn't send out the right message. And the last bullet is also very important. The taxpayer, it's not appropriate to compromise if the taxpayer is a company or a trust and SARS has not first explored action against or recovered from the personal assets of the person who may be liable for the debt. And this now links in again with the Companies Act, which the Companies Act places burdens on companies if they are trading under insolvent conditions. Then there may be personal liabilities for the directors or the public officers. And if there has been reckless trading by the directors, then SARS may collect the taxes from the directors in their personal capacities as well. So the procedure for that, it is an agreement, and that agreement will state that it is in full and final settlement of the tax liability, and it will also, the agreement will also then say whether assessed losses are forfeited, and then that agreement is then binding on SARS, it is binding on the taxpayer, and generally, if it deals with a specific year, that year is then absolutely closed. It should not be subject to any more investigations or on any audits or requests for information. SARS is not bound to that compromise if the debtor fails to disclose a material fact to which the compromise relates, or there's material incorrect information, and or if the debtor is then liquidated before they've fully complied with this. So in this period, compromise is a powerful tool, but full disclosure and compliance is required in all instances. SARS can then go and say, as you may recall, I talked about the temporary write-off of a debt, and this is a permanent write-off. So in this case, the taxpayer is actually informed of this. So this is dealt with Section 197, 198, and 199. So this happens to the extent that SARS is satisfied that the tax debt is irrecoverable in law. So the company has been liquidated. It doesn't exist anymore. So in law, there's no possible opportunity to recover an amount anymore. It is also if the debt is compromised. You can see if there's a compromise, then there will be a separate step that SARS will then permanently write off this debt. So SARS must notify the taxpayer that this debt has now been formally written off and that it has been closed. Now, before a decision is made on the write-off of the tax debt, SARS must do certain things. They must determine whether there are any other tax debts owing to SARS by the taxpayer. So if this is about writing off an income tax debt, they must look at whether there is any VAT or PAYE or anything else. They must reconcile all the amounts owed by and to the taxpayer, penalties, interest, and the like. They must obtain a breakdown of all the tax debts, and they must document all of this history and in order to substantiate the permanent write-off of this tax debt. So this will be happening if the taxpayer is due an amount to SARS and he may have struggled to pay all that amount back. So let's get to some practicalities. As we speak, most of us are, and as we're listening to this webinar, most of us will be sitting at home. So most of us will be salaried employees. So during this period, a salaried employee may incur additional costs, and what are the consequences of that? So let's first look at what the law says. And let's recap. So Section 23 contains certain prohibitions. Section 23B is the prohibition that says no deduction can be claimed for domestic or private purpose, for private expenses. So that's generally your private house. You can't claim any deduction. Then got an exception in 6, except in respect of such part as may be occupied for the purposes of trade. So the general rule is you can't get any deduction for private expenses and domestic private expenses. Exclusion for part of the house that is occupied for purposes of trade. So that is your private study, or if you're a doctor and you're part of that is your practice, then obviously you can get the deduction. But then there's a proviso to that. And it will be deemed not to have been occupied for the purpose of trade unless that part is specifically equipped for purposes of taxpayer trade and regularly and exclusively used for such purposes. So you can't just work from your lounge and then try, and that doubles up as a lounge, and use it for that purposes. You can't just use one room in the house and it's dual purposes for as a spare bedroom, and then that is also where you conduct your trade from. So it must be specifically equipped. It must be exclusively used, regularly and exclusively used for that business purposes. But then there's an no deduction. If you're in employment, if it's in employment, then it becomes very difficult. If you can only get a deduction for this home study expenses if your income is mainly from commission or other variable payments. So a person working for a fixed salary can't get this unless his duties are mainly performed in such way. So if you earn a fixed salary and you work more than 50% of the time from home, then you can get a deduction for your home study. If you are employed and your income is from commission, other variable payments, then you can also get a tax deduction for your home. Now, and let's see what section 23M says. 23M places a prohibition on certain deductions for a salaried employee. So it says that no deductions can be made for any person in employment, but it's got then exclusions, and the first exclusion is the general exclusion, pension fund, provident fund, retirement fund contributions, and then any allowance in terms of 11C. 11C is your legal expenses, 11E is your wear and tear allowances, I is bad debts, and J is doubtful debt allowances. So for an employee, that's the only deductions that you can get. Also, then, and any deduction 11 in A or in B, that is when you've received any income, pay tax on it, and had to refund it. Okay. And then it links back to the home study, is then 4. So you can get a tax deduction for the home study deduction. So when you think if you're an employee and you work from home, you have to consider section 23B, and you've got to consider 23M. But in salary, the salaried employee is generally prohibited from claiming any home office expenses unless his duties are mainly performed in such a more than 50%. So if you're just here for 3 weeks when the lockdown period is, that's not mainly from home, it must be more than 50%. But as life changes and as we progress, I think there will be a trend towards encouraging people more to work from home, and that may be more relevant going forward. So if you're a salaried employee and you've got your own, if you're a teacher and you've got your own computer, you'll be able to claim 11E deduction on the computer, but that computer must be used mainly for business purposes. But I have found in practice that SARS generally queries this, and it becomes quite difficult to claim this allowances. Then we're looking at now, over this period, how can an employer reimburse the employee if the employee now incurs real business expenses? And the employer says, let me reimburse this for you. I don't want you to be out of pocket. The employer can generally do this in one of 3 ways. The one is a fixed allowance, and a fixed allowance that he does not need to substantiate. The other one is an advance, and then he must substantiate the amounts that is not spent, and any unexpended payments must then be refunded to the employer. Or then thirdly, he first pays it, and then there's a reimbursement of that. So let's look at what the law talks about the difference on that. Interpretation Note 14 is quite comprehensive, and I've taken out some statements that we can just recap our knowledge on this. So the first one is an allowance. As I said, an allowance is like a fixed entertainment allowance, a fixed travel allowance. It's a fixed, it's just a monthly allowance that is paid. If you don't spend it, you can still keep it. Now, an allowance is generally tax inefficient because it's taxable in full. A cell phone allowance is taxable in full. If it's a Wi-Fi allowance, it's taxable in full. But it's administratively efficient. So from an employer perspective, you can agree, I will pay you 2,000 Rand a month as a home study allowance. And you can use it whatever way. You can put that for Wi-Fi, you can buy a computer, you can do whatever you want. I don't care, I don't mind. That amount will be taxable in full. It's administratively efficient because the employer just regards it as part of his employment costs, but it is tax inefficient because against that allowance, the employee can actually only claim an 11E deduction. An advance is tax efficient, but administratively inefficient, as is a reimbursement. So advance is, the employer will say to the employee, here is 2,000 Rand, use it and go and buy anything that you need for your business. So you can use it to go and buy ink cartridges, you can use it to buy paper, you can use it to buy a computer, which will be registered that will be my property. Here's an advance, go and substantiate that amount, and then whatever you've not spent, you must give back to me. And then they will then be reimbursed for that. It is tax efficient, but obviously there's a whole host of work that's got to go. You've got to give the advance, the employer's got to go back and refund the amount that's not been spent, or if it's been underspent, there's got to be an additional amount paid, and it becomes administratively very difficult to do. Also, from a VAT perspective, you also have to see in what capacity is the employee now actually incurring this expense. So if the employee then goes and buy an ink cartridge, the question is he buying that ink cartridge as an agent on behalf of the employer, in which case the employer can claim the VAT on that ink cartridge, and the same will apply for paper, anything like that. And most of the cases, you can say the intention was not that he buys the ink cartridge for his own benefit. It is the ink cartridge is there for his employer's business, and therefore it was incurred as an agent on behalf of the employer, and then the employer can claim it. If the employee buys that ink cartridge for his own account and then just gets a reimbursement for it, then what happens is the employer can't claim that VAT because the cost is not incurred as an agent on behalf of the employer. It is incurred as a principal by the employee and is just reimbursed for the VAT inclusive amount there. So if you structure this properly, and if you clearly can say that this cost has purely been incurred as an agent on behalf of the employer, then you can claim the VAT back as well. So it could be VAT efficient. Reimbursement is the same thing. From a VAT perspective, the question comes in, was that business expense incurred as agent on behalf of the principal, or was it incurred as a principal in their own right? It's only if you incur it as an agent that the employer can claim the VAT back. It's then also advisable that you get the invoice in the name of the employer. But if you do not get that invoice in the hands of the employer, Section 54 of the VAT Act allows the principal to claim the VAT even if the invoice is made out in the name of the agent. It's just important that there must be sufficient records to identify the principal, and generally what you'll do is just write on that invoice, incurred as an agent on behalf of the principal's name, the principal's VAT number, etc., etc. So an allowance, it can be efficient if the employer says, well, I'll just do this. Let me just put 2,000 Rand a month, or 1,000 Rand a month, or 500 Rand a month. I don't want to be bogged down. It is just simply not worth it. An advance reimbursement, if it is worth it, then it can be tax efficient. Also, just going to the way that the Act is set out. The way that the Act is set out in Section 81A, it includes in taxable income all allowances and advances. So it deals with your travel, subsistence, and all these things. But look at the second bullet. It provides that all such allowances and advances must be included in the person's taxable income to the extent that they are not expended. There's often a misconception that you claim a deduction, for example, against your travel allowance. I claim, how do you do my deduction for my travel allowance? I take my actual kilometers multiplied by a deemed amount per kilometer. I'm claiming a deduction. It's actually technically not correct. What happens is that the net amount of your travel allowance gets included. So if your travel allowance is 100,000 Rand and your calculation of your deduction, in inverted commas, is 80,000 Rand. The way the law works is not that you include 100,000 and deduct 80,000 Rand. The way that the law works is that you only include 20,000 Rand in your taxable income. So a net amount of 20,000 Rand comes in taxable income. And that works the same for any expenses that's been, for example, subsistence as well. So it's the net amount that gets included. Okay. What is excluded? So Section 81A excludes reimbursements or advances from taxable income if the following requirements are met. The reimbursement or advance was or must be expended by the recipient on instruction of the principal in the furtherance of the principal's trade. So the employer tells the employee, I want you to go and buy 5 ink cartridges for that printer, and that is for my business, and you need it because you need to do some printing. I need you to enter into that cell phone contract, especially for that. It is my cell phone, it's not your cell phone, specifically for my trade. The recipient must produce proof to the principal that the amounts were wholly and actually expended for this purpose. So you can see it's wholly spent for this purpose. The recipient must account to the principal for the expenditure, and the expenditure was or will be incurred to acquire asset and ownership in that asset vests in the principal. So if it was for an asset, then the ownership of the asset must vest in the principal. Even something like a cartridge. The cartridge is the property of the principal. It's not the property of the employee. So if, for example, the employee has got a cell phone, which is already an employee's name, okay, then one needs to look at how you can reimburse actual costs on this. So the evidentiary issues becomes an issue. So I mentioned now the cell phone cost. So let's assume in this period, an employee, he's got a cell phone. So he's got a private cell phone, but now for 3 weeks, he's got to work from home, and he's now going to phone, make a lot of calls for business reasons. So if the employer says, well, okay, you keep your private cell phone, here is another cell phone, just go and buy airtime on this phone, then clearly that airtime on that phone would be specifically for business purposes. If the employer says, yes, airtime on the phone, but the cell phone is used for private as well as a business periods, it becomes a bit more difficult. One can go through and say, let's get a detailed billing and apportion the total cost on that ratio. That should be acceptable. And at the end of the period, here's the total billing, and the employee will say, I've got this cell phone contract, I've got a billing statement, I've now portioned it based on the calls made for business purposes, the calls paid for private purposes. 60% of the calls were for business purposes, so I'm claiming 60% of my monthly cost now on this basis. Generally, that should be acceptable. Okay, it becomes a bit more difficult if the employee already has a cell phone contract with either free minutes or unlimited voice calls, and then you can run into problems. Is there any marginal additional cost for business purposes? But a reasonable basis of apportionment. In this case, you can't claim any VAT. You can't argue that the cell phone cost was incurred, this extra cost was incurred as an agent on behalf of the employer, because the contract is between the cell phone provider and the employee. So the VAT incidence is between the cell phone provider and the employee. It's not between the cell phone provider and the employer. So if the employee can, at the end of the 3-week period, do an analysis of his cell phone costs and say, well, here is a list of all my calls that I've made for business purposes. This is now purely, and I want to have a reimbursement. That should be acceptable. It becomes difficult for Wi-Fi costs and the like. If the employee, for example, does not have any Wi-Fi, and the employer says, I want to put Wi-Fi costs in, then that Wi-Fi cost is actually exempt from tax if the employer then incurs that cost, if the employer pays for the cost, because any communication cost, which is mainly used for business purposes, is actually exempt. And there's an additional slide on this. If the employee already have a Wi-Fi cost, he's got unlimited Wi-Fi, and he had that forever because he watches Netflix and he already needs it, then there's no additional cost for the business, and SARS may argue that there is no additional business cost and refuse a reimbursement of that. So this can be slightly difficult in practice. Okay. There is an exemption for the use of any assets. So if the employer provides the employee with the use of assets, so the ownership of the asset vests on the employer, there's a split between telephone and computer equipment and any other assets. So telephone and computer equipment only needs to be used mainly for the employer's business. That means more than 50% must be used for business purposes. Then it would be regarded as tax-free, and that's exemption from the use of assets. If it is, for example, a table, equipment or tables and chairs to be used to furnish the home study of the employee, then it will only be tax-free if the private use is incidental. So that table, the chair, and the like is only tax-free if its private use is incidental. It's interesting that the use of books, literary recordings, or work of art is entirely free of, that's not a use of asset, there's no tax on that. Okay. Then there's a paragraph 10 of the 7th schedule, exempt from the free of cheap services. No value shall be placed under this paragraph on any communication services provided to an employee if the service is used mainly for purposes of the employer's business. So that is, again, mainly is more than 50%. So if the employer provides Wi-Fi service for the employee, or puts in specifically a telephone line for the employee for business purposes, if more than 50% of that is business purposes, then there is no liability. So, but this is quite important, that the employer must be liable as principal towards the supplier of the Wi-Fi or the telecommunication line. In that case, the employer can then also claim the VAT on it. So it may be worthwhile for the employer to put in Wi-Fi at the employee's house. If more than 50% of the use of the Wi-Fi would be for business purposes, then that will not be taxable at all. But then the employer must do that as principal. Okay. So let's look at, that is now the employee working from home. We've talked about his home study. We've talked about the reimbursement of certain expenses that he may have and what the current legislation, because there's no change in legislation on this. One can ask, should there not be a change in legislation? And that is obviously a different debate, because I think if the government wants to have social distancing, then it should also be encouraging to do that and make it easy for employees to work from home and not incur certain costs. So how can the employer assist? So let's talk about bursaries. All of you are, sorry, this is bursaries. So we first talk about food and basic necessity assistance. What does it say if the employer wants to assist the employee with certain vouchers to buy necessities? Paragraph 2 of the 7th schedule taxes certain things. So 2A taxes any assets of goods and commodities. So if you were to provide goods and commodities to employees, that will fall within paragraph 2A of the 7th schedule and automatically be taxable. And that will include any vouchers for that. 2C will tax also the employee has been provided with any meal or refreshment or voucher, and that will be valued in terms of A2. And then D talks about residential accommodation. So on the face of it, if you were to provide anything, that will be taxable. So let's see what paragraph 8 says. So paragraph 8 talks about the taxation of meals and refreshments, and it only has exemptions from no value shall be placed under this paragraph on any meal or refreshment supplied by an employer to his employee in a canteen. So clearly this is not applicable anymore. Or any meal or refreshment during business hours, or when you are entertaining somebody. So in the current scenario, there is no tax benefit, there's no tax break if an employer will provide assistance in the form of meals to any employees, unless it falls in the canteen at the employer's place. Now, there's many employees that are now suffering hardship because there could have been a canteen, a subsidized canteen at the place of work, and now they do not have that benefit. And employers may say, well, I'll give you an allowance or give you a number just to put you through it. It would have been nice if the legislator would have expanded this extension to the COVID-19 periods. So in summary, any food vouchers, shopping vouchers, anything like that, it is taxable in full, unfortunately so. So let's talk about bursaries. So this period of time, this is a good time for employees, especially if you're still paying salaries and you're not putting people on unpaid leave, that they can make the most of it. So it can be specifically used for this. So if there is training provided to employees and it is business related, then it is fully exempt. This is, for example, any courses that you may attend through site, any webinars that you may attend, any Excel courses, anything that might be business related, it will still be exempt. So the employer can pay for it, they can claim the VAT if there's a VAT charge on it, and they can claim for it. This is in the law, and this is for bursaries for relatives of employees. And one can consider using that, especially if an employee is suffering hardship and is unable to pay the school fees for his employees. So the exemption for bursaries for relatives of employees will only apply if the remuneration proxy of that employee is less than 600,000 rand, so employees earning less than 600,000 per annum. The bursary is bona fide, so it's not a disguised salary, and the amount does not exceed 20,000 rand for grade R to 12 and NQF levels 1 to 4, or the amount does not exceed 60,000 rand per annum for NQF 5 to 10. So that is a good opportunity in this time that if the employer says, hang on, you are suffering hardship, let me still pay the school fees. Your child may be at varsity, or his child may be at school, and let me assist you with those school fees, and try to assist the employee in that manner. So let's see what the SARS Guide for Employers talks about bursaries and study loans. Study loans is exempt from tax, so there is no fringe benefit tax on the study loan, but it becomes a fringe benefit once he is now obligated to pay it. If he's now stopped paying the stop studying, then they are required to subject it to fringe benefit tax. Also, if a bursary is converted into a loan, so you granted somebody a bursary, and that bursary is subject to the condition that the employee must pay it back. At the point, if he's now unsuccessful, and he now pays it back, that is not a study loan. At that point in time, there will be a fringe benefit tax on it, because a study loan is there to allow somebody to study. It is not, once you are unsuccessful in studies, now I've got to pay the bursary back. That is not a study loan. So there's a big difference between a loan and a bursary. A bursary is also exempt because a bursary is granted to enable somebody to study. So you generally grant a bursary at the beginning of the year, and you say to a person, here is money, or I'll reimburse you with the expenses as they come along, but it's enabled to study. If the person is then unsuccessful, he's got to pay it back, then that becomes a study loan, and there'll be fringe benefit tax on it. If you say to somebody that I'll grant you a loan, and then if you're successful, you don't need to pay back the loan. That forfeiture of the loan will be taxable in full, because a bursary is something to allow you to study. But if you, at the end of the studies, if you, as a reward of successful completion of the studies, provide somebody with a lump sum, that is not a bursary, it's a reward, and that will be taxable in full. Okay, so just go through that, make sure, but over this time, it may be worthwhile exploring whether or not there could be bursaries granted to employees. At that point, we can look at casual loans. What are the rules regarding casual loans? So paragraph 11 of the 7th schedule says that the cash equivalent of this benefit, if you provide a low interest-free loan, will be calculated on the difference between the official rate of interest and the amount that the employee actually pays. The following exemptions applies, and I've already talked about the exemption for studies, but A is a no value shall be placed on a debt owed by any employees to his employer if such debt or the aggregate of such debts does not exceed the sum of 3,000 rand at any relevant time. Now that 3,000 rand has remained constant for the past 10 or 15 years. It would have been nice if SARS would have extended that to a bigger amount, especially under this time where employers may say, well, I'm putting you on a reduced pay, but in certain instances, I may provide my employees with loans in order that they must pay back over time, and that could have been exempt from fringe benefit tax, and if the employer could have provided them with soft loans, especially if that employer is now also getting assistance from SMEs to have those loans to have that loans funded. So it would have been nice if the 3,000 rand could have been 30,000 rand. That would have been nice at this stage. There's also an exemption for a debt owed to the employer in consequence of where that employee acquires an immovable property, but it only applies if the market value of the property is up to 450,000 rand, and if the remuneration proxy of that employee does not exceed 250,000 rand. So employers can provide interest-free loans to employees earning up to 250,000 rand to acquire fixed property. In this section, I would just like to discuss the tax treatment of subsistence allowances, and this may or may not apply to an employee who went overseas for business reasons, couldn't return in time, and now is trapped overseas. And then the question comes in, can the employer just continue to pay subsistence allowance? Can they continue to pay for accommodation or the like? So one never knows whether these things happen. So let's just look at what Interpretation Note 14 says about subsistence allowances. So firstly, in the Interpretation Note 14, I jump to the paragraph 6, which talks about employees tax. And it says that subsistence allowances are generally not subject to employees tax. So subsistence allowance is generally, you're not allowed to enjoy the benefit of a subsistence allowance if it's just a fixed amount. So here is 2,000 Rand per month. No matter whether you have to substantiate it or unsubstantiate it, here's just 6,000 Rand or 2,000 Rand a month to be paid for that. The reason for this is this second red circle. It says this ensures that subsistence allowances are not used as a form of salary structuring by employers. They do not want this to be brought into your total cost to company calculation. It must be over and above. Subsistence allowance must be when you travel for business purposes and you're away from your normal place of work and your normal place of residence for more than one night, then the employer can incur certain costs, and that will be tax exempt. And there are also certain deemed costs that you'll talk about now. And at a point, that was quite a nifty way of structuring your total salary, and people were building in a subsistence allowance as part of the salary, and then they on a monthly basis, they either claim a bit against it or don't claim a bit against it. But the idea is that subsistence allowance would be over and above. So generally what will happen is, again, it can be an advance or it can be a reimbursement. It can never be just a fixed monthly allowance. If it's a fixed monthly allowance and you pay tax on it, it's inefficient and you can't claim these things against it. But if it is a over and above, so an employer may say, okay, I understand you've got to go to America now, and here is an advance or subsistence allowance of 10,000 Rand for your trip. So essentially that does not get taxed to employees tax, but in the month following the month in which the trip occurred, then it must be included in the remuneration to the extent that it has not been actually spent or deemed to have been spent. So if you provide somebody in January with an allowance and the trip is in January, the person must go on the trip, he must get his evidence, the number of days. If he's claiming the daily allowance, he must deduct that and return whatever is excess in the following month. Whatever portion has not been returned the following month must then be fully taxed. Okay. So and again here they talk about the deductions from subsistence allowance. I suppose it's, as I said earlier, it's actually a net amount that comes in. It's to the extent that the subsistence allowance has not been spent on business purposes, that net amount gets included in income. But let's work on this description. So it says the recipient may only deduct subsistence-related expenses from the subsistence allowance if the recipient is obliged to spend at least one night away from his usual place of residence in the Republic by reason of the duties of his or her office of employment. And that is quite important. It must be by reason for his duties or his office of employment. Okay. So if by reason, the reason for the recipient's away from home must be related to his office of employment. That is very important. So then you can either claim the actual or the deemed, or a bit of a combination to it. Under the actual method, the amount they deem to have actually spent is equal to the cost of accommodation, meals, and other incidents, excluding any amount that the employer has paid. Okay. Under the deemed method, there is certain amounts that SARS have gazetted in the government gazette. So the gazetted amounts for local, for meals and incidentals, is 452 Rand per day. So if you're away for one night, you can get 452 Rand for 2 days. If it's incidentals only, it's 139 Rand per day. So if it's meals and incidentals that you have to fund yourself, the accommodation must always be actual. So if you go away locally and the employer pays the accommodation and they pay for the meals, then over and above that, the employer can give you 139 Rand per day for incidentals. That's for dry cleaning, and that is for snacks or stuff like that during the day. That is for incidentals. Then they can give you 139 Rand a day. If you're away for one night, they can give you 139 Rand times 2. If the employer pays only for the accommodation and not for meals, and you must pay for meals and incidentals yourself, then it's 452 Rand per day for that meals and incidentals. Okay. For foreign, it's for meals and incidentals, so the accommodation must always be the actuals. Then if you are required to fund out of your subsistence allowance, then your employer can give you, for example, for USA, $146 per day. It varies per country wherever you are. There's a list that gets submitted every year. The 2021 list is exactly the same as the current year. So what will happen? So let's assume an employee has traveled overseas and his only reason was for business. He left South Africa, he had to go overseas, he had to either repair a machine that was in Ghana, and as he was there was a lockdown and he can't return to South Africa. His sole purpose is business. Now he's trapped in Ghana, he can't come back. In that case, one can strongly argue that there was a sole purpose, even during this lockdown period, even if you can't do anything there, is there for business reasons. There's no other reason for business reasons. So one can argue that he would have gone there for 3 days. Now he's stuck there for 3 weeks. During that extra days, the employer can still pay for his accommodation. They can still pay for this $149 a night, whatever the rate would be for Ghana, and that should still be exempt. That is relatively simple. However, it becomes much more difficult. So if an employer has traveled with a sole purpose private, clearly, if the employer pays anything, it will be fully taxable. So if the employer went overseas for a leave and is now trapped there, and the employer says, well, okay, I will pay you certain amounts in order to fund that, that will be absolutely tax-free. But it becomes very difficult when there's a dual purpose, because often employers will say, okay, I have a trip to Europe, and I've got to be there for a course, or I've got to be there for a meeting or a conference or something. But at the end of the day, I will then just extend it. I will just spend the weekend and do a bit of sightseeing. I come back, instead of coming back on Friday, I'll come back on Monday or on Tuesday. Then clearly the portion which is private. So if you are there for the conference, if you're there for the meeting, or whatever the purpose, during that period, you can receive the subsistence allowance as tax-free. During that weekend or up to the Monday when you are now there for private purposes, then that period, there can't be any subsistence allowances. But now you wanted to return the Monday. Now you can't for another 3 weeks. And you say, well, 80% of my purpose was business. I've just extended it. There's no additional marginal cost. I wouldn't even have had the private element if I wasn't there for business. So my private element was just incidental to the total. It becomes very difficult in that scenario. It also becomes difficult if the private element is either at the end or at the beginning, because you may have gone on a private element at the beginning of the trip, then at the conference, the end of the conference, or during the conference, it's now lockdown, you can't return. Then you can say, well, hang on, this is just an extension. I would have attended this conference in any event. You need to pay me my subsistence. This is holy. But it becomes very difficult if you were there for business purposes, you extended it for private purposes, and the lockdown occurred during the private element of it. So there's no rulings from SARS. There is no clarity from SARS. My recommendation would be that SARS actually approach for a binding private ruling and to say, can we or can't we issue subsistence allowances under these scenarios? I hope that SARS will be lenient, because this may cause certain hardships for employees if they are trapped overseas for business purposes, or even extended where the primary purpose was business and you've just extended it slightly for a private weekend or something, and now they're trapped there, and SARS says these allowances must now be taxable in full. So let's talk about the travel facility from home to work, because there's now all kinds of restrictions on the number of people in taxis. The Gautrain doesn't work, but certain people still need to get to work if you are in specific industries, and if it's a crucial industry to get there. So what can happen on this? Firstly, what does the Act say? Paragraph 10 of the 7th schedule to the Act effectively puts a taxable benefit on any travel facility granted by an employer. But then they say, no value shall be placed under this paragraph on transport services rendered by an employer to his employees in general for the conveyance of such employees from their homes to the place of the employment and vice versa. So this is quite specific, and there's been a number of rulings and guidances on this by SARS. Now, the first thing what we want to look at is just transport services rendered by an employer. So the employer must be contracted to whoever provides the transport services to the employee. It can't be that the employee is incurring a cost and the employer just reimburses it. Okay. And it must be to employees in general. So it can't be for a specific employee, it must be to employees in general for the conveyance of such employees from their homes to a place of employment. Okay. So what does Binding Private Ruling 262 talks about a shuttle service concept? It talks about the direct service concept. So in a shuttle service context, in this environment, what happened was the employer provided shuttle services, and that can happen, a shuttle service from the Gautrain to the place of work at the employer, to and fro, and they provide that for employers in general. Now, the exemption there was provided because the employer was liable towards the operator of the shuttle service for the payment of, the employee just paid nothing. So it was not a reimbursement. They said the moment that the employee incurs a taxi cost for themselves and then gets reimbursed for it as a principal, then the exemption doesn't apply. And the direct service was also at certain collection points close to their homes. And in this case, there was no value will be placed on the taxable benefit to be granted by the applicant to its employees by rendering a transport services to them to convey them from the public transport interchange or a collector's point to their place of work. So there's opportunity for the employers to enhance the travel to the employees during this period. Okay. But if an employer agrees to refund the employee for an Uber cost and the employee used this, then this will be a taxable benefit. And Uber is also not for general, it's very specific. So in this case, an Uber cost, for example, will be taxable in full. Okay. So it is unfortunate. It would be nice if some of these legislation that has been prepared in different times are now amended a bit. Let's talk about travel allowances. Many of us are earning travel allowances, and against the travel allowance, you want to claim a tax deduction. That tax deduction you get by taking the business kilometers per logbook and multiply that by either the actual cost per kilometer or deemed cost per kilometer. All right. So the question comes in, what is business-related expenses? So the Act says, and Interpretation Note 14 says, in this regard, Section 81B1 provides that traveling between a recipient's place of residence and place of employment or business is private travel. Okay, so the location of recipient's place of employment is a factual inquiry. So clearly, by law, the travel between your place of work and your private residence is a private expense, and you can't put that in as business kilometers in your logbook. So let's look at this case study. You're a managing director of a mine or large factory, and somebody phones you and says there's been theft at the factory. Clearly, you need to get in your car, you've got to drive there and see what's going on. Or you can be the manager at a restaurant, and somebody tells you that the electricity has went out, and all the meat in the fridges has gone bad. You need to get in your car, you need to drive there. This is an emergency situation. The question comes in, during this period of lockdown, can that be regarded as business travel? Because now this is purely for business reasons. This is still a travel between your place of home to your place of work, and that will still be regarded as private travel, which is unfortunate. So I think it is a deficiency in the way, even before this lockdown period, because people may be on standby, and I believe that anything that you do after hours should be regarded as business kilometers. The same would apply, for example, an electrician, and he works for a company providing essential service. It may be a warehouse that is distributing food, and his job is to make sure that the electricity will always work perfectly. So he works during the day, make sure that everything's happening. At 1 o'clock in the morning, he's now obligated to repair a transformer. If he's then reimbursed at $389 per kilometer for traveling from home to the warehouse and back, that is again regarded as private travel. It can't be business travel, and he will be taxed on that amount, and he can't claim nothing about it. Okay, and that is unfortunate. I think these things was actually historically a problem, but it may become a problem now even more so. Talk about the right of use of a motor vehicle, and then the question comes in, I have got the right of use of a motor vehicle, how do I get taxed on this? And this is taxed, paragraph 2b and paragraph 7 of the 7th schedule. Simplistically speaking, you take the determined value of the vehicle, and if that vehicle is subject to a motor plan, you take the determined value, you multiply that by 3.25% per month, and that is the amount that appears on your RP5. Only 80% of that amount is subjected to PAYE. In your tax return, then, you can claim two things. The one is if you kept a logbook, you reduce that amount with your business kilometers. So effectively, it's the percentage business kilometers that you've traveled. And then what remains is your private element. And then if you are liable for the full cost of the fuel, you take your private kilometers, multiply that by the rate per kilometer in the SARS table, and you claim that as a tax deduction from this private element. So it can be quite complex, but it starts off with a calculation of determined value times 3.25%. If it's not subject to a motor plan, it's the determined value times 3.5%. If the employee uses the vehicle more than 80% for business purposes, then it is you're only subject 20% of that amount to PAYE. So the question comes in, I'm now in lockdown, I'm sitting at home, I've got a company car, I'm not allowed to use it for business purposes. Why should it be taxed at all? Why should it be taxed at all? Let's look at what the Act actually says. And the Act says it is not the actual use of that company car. It's the right to use the company car that is subject to tax. So even though you may not factually use that company car, it's the fact that you've got the right to use that company car that is taxed. So you can't reduce it. So you're entitled to use it. Also, paragraph 7.5 deals with this specifically. It says no reduction in the value shall be made for the purposes of item B by reason of the fact that the vehicle in question was during any period, for any reason, temporarily not used by the employee for private purposes. So, sorry, you will be taxed even if the car is standing there idle. If there's extended lockdowns, an employee may formally give up the right to use the motor vehicle, but that must be formal. The vehicle must then not be at the premises of the employee, must not be entitled to use it, and the onus of proof would rest on the taxpayer that this is not a sham transaction. So what is a sham transaction? It's effectively fraud. Sham transaction is that you will say, well, you know what, I don't have the right to use the vehicle, but in actual fact, you do have the right to use the vehicle. It is, you're a manager at the company, they acquired a vehicle specifically for your purpose. Then you say, no, hang on, for 3 weeks, I've got to sit at home. You take the vehicle back. I'm just going to sit at home. I don't want it, and you sign an agreement to say for these 3 weeks, I'm not going to use it. And then after 3 weeks, you just carry on using it. It was never really the intention that car, that you'll cease using the car. So if you're going to go this route, then you have to do it properly, and the onus of proof will rest on you that this is not a sham transaction. It'd be difficult to prove, especially if you then coming back to work, you just continue to use the car as normal, as if nothing has happened. Okay. There is an exemption from being taxed as a company car, and that is your so-called pool vehicle exclusions. So it says here, for the purpose of this paragraph, the private use by an employee of a motor vehicle shall be deemed to have no value if the vehicle is available to and in fact used by employees in general, the private use of the vehicle is infrequent and incidental, and the vehicle is not normally kept at the premises of the employee. So that's your typical bakkie or combi standing at the office, and that is used purely for business reasons. At the afternoon is brought back to the office and it's left there. So if the employee may use it to go to shops quickly and come back, then it's incidental, then there's no value on it. Or the nature of the employee, so that vehicle must then be kept at the premises. And this is one, the nature of the employee's duties are such that he is regularly required to use the vehicle for the performance of those duties outside his or her normal hours of work, and is not permitted to use that vehicle for private purposes other than between his place of work, and his private use is infrequent or incidental. So when he returns from work, he may stop at the shops and go back again. But if he's using it for going on holiday, then that exemption does not apply. So in this case, if an employee is on lockdown and the employer says, listen, you've got a crucial job, you need to make sure that if there's a security risk or if there is if there's electricity will go down, you need to then you can provide that person with a bakkie, but he's not allowed to use it for private purposes. He can take that bakkie and go to work and back, and then it should not have any fringe benefit tax consequences. Section 1010 was changed recently. What that section deals with, it deals with foreign employment income, and it deals with if an employee is physically outside South Africa for a period or periods exceeding 183 full days in aggregate during a period of 12 months, or for a continuous period exceeding 60 full days for 12 months. So there was a recent amendment to that only comes into play now recently. Previously, there was no monetary limit on it. Now it only applies for to the extent that the remuneration does not exceed 1 million rand in the year of assessment. The position can happen that if a person is now required to stay overseas for another period, 3 weeks, 4 weeks, maybe a month, whatever the situation is, that they may fall within this. But it becomes a bit difficult because the reason you must be outside the Republic was on behalf of the employer. And in working out these days, just be very, very careful that you comply with the requirements of Section 1010, because if you are there for private purposes and you were there maybe a combination of it, then you may or may not count the days that you are there for private purposes. Okay. What happens on medical assistance? Let's first look at what the law says. Again, we go to paragraph 12B of the 7th schedule. It says that the cash equivalent or the value of any taxable benefit in 2J is the amount incurred by the employer in respect of any medical, dental, similar services in respect of that employee. So the general rule, it is taxable. Okay? Even employer contributions to a medical aid fund is taxable, and then the person gets certain rebates. So no matter what you do, it will be taxable. Okay. But then there is certain no benefits. It's a no value must be placed in terms of this paragraph on a taxable benefit resulting from the provision of medical treatment listed in any category of the prescribed minimum benefits determined by the Minister of Health. Okay. But there are certain requirements. The employee is not part of a medical scheme. So effectively, if the employee was part of a medical scheme and you provided the contributions to the medical scheme, it would have been deemed to be a fringe benefit in the employee, but you could get credits. Now, if you don't have a medical scheme, but what you provide to the employee is exactly the same as the minimum benefit of what the medical scheme would have allowed, then that is then exempt from tax. Okay. This is also an exemption. No value must be placed on any where these services are rendered for purpose of complying with the law of the Republic. So if the law of the Republic, for example, said that you must have a hospital on your premises, at a mine, or you must have a clinic on the premises, then there will be no value on it. Also, the last point C is where the services rendered by the employer to the employees in general at the place of work for the better performance. So that's typically a clinic at work. So on the face of it, there is no real exemption if an employer will say, I will assist my employees in paying certain medical costs. I'll provide them with masks or anything like that. So if an employer reimburses his employees for the cost of mask or sanitizer, for work purposes, obviously that's just work, that's tax-free, but if it's for private purposes, it will be taxable. And then if they pay for medical costs not covered by medical aid, it will generally be regarded to be taxable. Okay. So let's just see, I've mentioned earlier that if you were to make a contribution to the disaster relief trusts, then that will be regarded as a Section 18A deduction. So this is in the actual disaster relief management tax bill where that deduction is now allowed. How can you now mobilize your workforce in order to try and get more donations into these trusts? It's interesting, and it's not used in many instances. but it can be taken into account for PAYE purposes. So it says the employer must deduct so much of any donation deductible from the remuneration of the employee in terms of Section 18A and pay such amount to relevant approved organization on behalf of the employee. So it may not exceed more than 5%. So what can happen is that the employer can mobilize its workforce and says, anybody that voluntarily wants to make a donation, tell us about it. We will deduct it from your salary. We'll take it into account for your employees' tax, and we will then, on your behalf, pay it over to these funds. And I think it can be quite a nifty way in order to get money in it, because even a donation of 10 Rand per month, if you add it up with all the employees, and they can get a tax benefit for it and a PAYE benefit for it, it can actually make a big difference at the end of the day. Ladies and gentlemen, thank you for your attention. Stay safe, enjoy the long weekend, even though you should, suppose, not experience any real change in the place that you are. Thank you very much and have a nice day.